Everyone cheered when the average Canadian home price dropped from $837,000 to $690,000. But the math still doesn't lie. Even with 8 rate cuts, homes are still out of reach for most Canadians. The story we've all been told about the Canadian housing crash is the biggest lie. I'm going to show you 10 irrefutable charts that cut through the noise and expose a terrifying truth about your mortgage and the future supply collapse, and why the crisis is actually worse than you think. Let's get right into it. Hi, my name is Zen. If you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. So the Globe put out 10 charts that talks about how the Canadian real estate market got to where it is right now. And it's actually a very good chart that I'm going to explain to you and provide you some context so you actually understand what the data is saying. The moment that prices came down, a lot of people were saying, hey, affordability, quote unquote, is being restored. Interest rates are coming down. So affordability is being restored. And we're seeing that with a lot of politicians talking about that. But it's the immediate lie. Affordability is not back for the average Canadian. And let's start with the first chart over here. This chart here represents the amount of price falling in certain pockets of Canada from the peak of the market. So the peak of the market, you can see over here, would have been in February 2022. But they're telling you right now that the average Canadian price is only down $147,000. And let me show you where that's from. This over here is the latest stats from the benchmark price from all of Canada. So this is the aggregate composite. This includes from east to west. And you can see in September 2025, the prices were $676,000. The peak of the pricing was over here at $830,000 for the entire country. So this $147,000 price drop is only what we call in nominal terms, the actual dollars. But if you actually look at what the Globe put over here, where inflation adjusted dollars, you can see that Hamilton is down almost as much as 40% and the GTA is down almost 34%. And while I actually do not like to use these inflation adjusted numbers, you have to understand that you have to use them to some context, because if you think about it, our parents who would have bought a property in the 90s or in the 80s, they bought a property for $200,000 in Toronto. But to buy that exact same property, it's $1 million. So is the property getting more expensive, or is it just the value of the dollar becoming less? And that's what inflation adjusted is. In the last 5 years, we've had a massive inflation price. So you just got to ask yourself, what prices were you paying for steak 5 years ago versus now? It's the exact same thing with real estate. So when you adjust it for inflation, prices are down upwards of $40,000, but it's still not affordable right now. And let me show you why. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. Because when we look at how we can buy a home, most people look at the monthly payment, and it's perfectly fine because we don't look at the cost of a car. When we buy something, we look at what it costs us to service the debt on that monthly basis. So what a lot of people, including mortgage brokers and bankers, do is that they look at a number called your GDS, which is what I have over here. It's called the gross debt service ratio. And in layman's term, what that basically means is that, hey, if you had $100 for income, you are allowed to use upwards maximum of 40% of that $100 for your home. So if you had a $100 income, you can use 40% of that, or $40, to service your home, which includes mortgage payments, taxes, heating, and all that kind of jazz. So for you to get a mortgage to qualify for that, you have to fit into that little box where you do not use more than 40% of your income to buy a home. Now, granted, there's always exceptions for exceptional people, but generally at a 20% down, that's how much they can lend you at. So when we look at this chart over here, which is looking at your median home price, which is right in the middle, not the average, and your median income, which is also right in the middle, what does affordability look like when we have a 5-year term at the current interest rates and a 25-year amortization? Now, I will note that you can make the numbers look a little bit better with 30-year amortization, but for the context of this and this chart, let's use 25-year. Why? That there's a lot of migration to Calgary, because Calgary in the last 5 years has actually still been affordable by that metric. But when you look at your bigger cities like Vancouver and Toronto, we have not been affordable for a very, very long time. Vancouver actually hasn't been affordable in the last century, which is wild if you think about it. So using those metrics, Vancouver got as high as 100% of a family's median income. Toronto got as high as 85 over here. So it's a lot of your income to service it. So how do people actually buy homes in Toronto or Vancouver? Well, you basically have to be the higher bracket of incomes, or you have a large down payment. And that's how people are getting into the real estate market in Vancouver, Toronto. So you're either gifted money for a down payment from family, plus, or having a really high income to service that debt so that you can only use 40% of your higher income to buy that home. So despite prices coming down 40% on inflation adjusted numbers, because remember, your income may not be inflation adjusted by how much inflation and CPI was in the last 5 years, things are still not affordable for the Canadian. So it's a lie. It's a farce. Because when we look at this chart over here, they're trying to make things more affordable. And we've had 8 rate cuts in the last year and a half. And guess what's happened? Sales have been flat. And I've been saying this for a very long time, especially talking to my potential seller clients or people who want to sell. And they have this idea that, hey, maybe the next rate cut's going to move the needle. But I'm telling you, since rate cut cycle happened in 2024, you can see sales have been flat. But you know what has actually been increasing? New listings. You can see over here this blue line, which represents new listings, and this maroon line, which represents sales. You had a very small gap, which basically meant that as new listings came in, they were being bought. And then that gap widened a little bit because of the pandemic, and then it shrank a little bit over here. And that's a very, very strong seller's market. But what happened in 2022 was that when the interest rates spiked, you can see this gap got bigger and bigger and bigger and bigger. It shrank a tiny little bit because Silicon Valley Bank collapsed over here, and then it shrank that little narrow margin. But then as rate cuts were happening, it got bigger, the gap got bigger and bigger and bigger and bigger and bigger. And it's looking like that new listings may continue this way while sales remain flat. And at the current pace in Toronto right now, we're on track to do less sales than we did in the last 3 years, which were 2-decade lows. So we're gonna set maybe even a 3-decade low in sales by the end of this year. This is how soft the market has been despite 8 rate cuts. It hasn't moved the needle. So affordability hasn't improved that much more because the sellers are digging their heels into the pricing right now, which leads me to the economy. There's a huge lie about the economy right now because it's not what people are saying. But when you dive deeper into the real estate market and how it's impacted by the economy, our market is sick. It's ill. It's like fatigued. And if you look here, we have a huge problem because Canada has a very, very unhealthy obsession with real estate. When we compare how the US, how they invest their money into residential real estate, you can see over here, it's about 4% of GDP or gross domestic product. For Canada, we're at 8%. We're 2 times that of the US. So what this basically means is that we are investing a lot of our capital into real estate properties. And when the market is booming, it's really booming because we're like 2 times invested into it. But when the market gets slow and we slow down, we really feel it in the economy because we have double the amount of money invested into real estate as a percentage of our GDP, which basically in layman's term, if you think about it, is like this. If you had $100 to spend in your entire economy or your household income, you would be investing $8 as a Canadian into servicing your debt and real estate, whereas your US counterpart only spends $4. So it means that there is more money to spend on other things if you're a US citizen, but a lot less money in Canada because so much of our money is going to service the real estate debt. So it's having a drag on our economy right now. And the other part of the sickness is that we're going to have a future supply problem. It's not a problem in like 2 years, 3 years, or 4 years. And I've talked about this in the past. It's more like 5 years, 6 years, 7 years, because in GTA and the Hamilton area, we are not building condos anymore right now, which is the entry-level product for a lot of people. Granted, we have 2 times that the amount of supply we normally do on the resale market, meaning like stuff you can buy right now that has closed already from the builder. But in like 5, 6 years, we're going to have 100 properties come up compared to where we had before, where like call it 10,000 units a month. It's a very stark contrast. This is where you see headlines where like 90% sales drop. It's in the new construction, pre-construction space. And this problem will come to roost at some point, but just not right now. And then the third symptom of our real estate market that is sick right now is that the delinquency rate is going up right now. So we always talk about a potential looming mortgage cliff, but I don't think that's going to happen. But it will bleed out at the seams, like I was saying before. Because if you look in this chart over here, this is a percentage of how many mortgages are delinquent right now. And delinquent means that they are 90 days past due and the lender has put them into power of sale. Now, how you read this chart is that Canada is this maroon line over here, and the percentage of delinquent mortgages is right here. So right now you can see that we are rising since 2022 when interest rates have hiked. And right now we are at a 0.21 delinquent rate. So what that basically means is that 1 divided by 0.21%, 1 in every 476 mortgages right now are delinquent and past due, which is not that many. But we're nowhere near as bad as in the 2008s where we had 0.4%. And keep in mind, if you're trying to remember where US crash was, they were at 10%, which is almost 20 times what we had in the 2008 crisis. So I don't think we're gonna get there. But the reason why this is important is that when you have a power of sale, it means that the lender is trying to recoup their money. So they don't really care about how much equity is in there because most of the equity is given back to the buyer. And where we're seeing a lot of these problems right now isn't actually at your big banks like your RBCs, your CIBCs. It's not even at your B lenders or your Alt-A lenders for like self-employed people. Where we're seeing a lot of this pain right now is individual private lenders. And what that basically means is that these are people who would have maybe borrowed from the HELOC and lent it to a developer or someone trying to buy a property, and they are underwater and they are power of selling. It could also be an institutional private, which generally could be like a mortgage investment corp, where they're lending out money to higher risk people. And those are the cases where we're seeing a power of sale increases at the fringe right now. But why this is important is this. When you have lenders who forego the equity and all they're trying to do is recoup their money plus legal costs, call it, they don't care what the price is. They just want to get their money back. So if there's enough equity in the property and they force the sale, it could sell for less than what the last comparable property was because they don't care what the market looks like or what it's going to sell for. They just want their money back, which means that in residential real estate, because your property is worth what the last person sell for it, if you have one of these private people who all they care about is recouping their money, they fire sell it, quote unquote, if there's enough equity, or it sells for less than the last comp, it brings the prices of the entire market down. And what that basically means is that you basically have a race to the bottom for people who need to sell versus people who want to sell. And that's why some sellers will delist eventually at some point because they're like, well, I'm not gonna make this sale right now because I'm not gonna sell for that price, let alone if they're maybe even potentially underwater themselves. So it's a trickle effect that takes time for this to kind of pan out. And that's kind of why prices are sticky on the way down, because you need the people who are motivated to sell to bring the entire market down. And it comes one at a time. Before you even think about selling, don't let another chatbot price your biggest asset. Your property is not just another number. Hit the link in the description below and I'll send you a personalized assessment with real data and expert insights so you can sell with confidence on your terms. Which brings me to the third lie, which is the long-term lie. The crisis is going to return. I'm not saying you need to buy something right now, but we are set up for another supply crisis, but it's not going to be anytime soon in the next 2 to 3 years, but it will return. Because you can see over here, the cities are taxing the crisis right now. Look at Toronto increasing their development charges per every new unit. And I've talked about this in the past before. It's absolutely unfair to the first-time homebuyers and a young generation. What's basically happening is a lot of these new units that are being bought on right now, if they ever go to market, they have a really high tax that basically gets passed on to the buyers. So in 2022, they were at 100,000 per unit in Toronto. And in 2 years, it's increased to almost 140,000. So it's increased 40%. And because it's increased, call it 40%, those taxes are just passed on to the buyer, which ultimately makes that price of real estate more expensive. You can see this across the board in the big cities like Vancouver, even in Brampton, and you can see in Burnaby in BC, in Hamilton and all that. Not as bad, but you can still see that there are increases at the margins over here. Burnaby is terrible for that. And until the cities decide to stop taxing on new development, it's going to be more unaffordable to build new development, which decreases the supply in the future when we have that supply shock and which increases the price. And this brings me to the failure where the governments have been too reliant on the condos right now to build supply. And that's what we kind of saw in Canada when we saw a condo boom in the last decade and a half. It went boom and it continued over here for 60K units every single year. But now that there's not much of an appetite for condos right now because of all the things I was talking about, your housing starts for condos is going to come down. But do you know what started? Rental buildings, because they created that financial product to help large institutional insurance companies or like big REITs to create these rental buildings. But you know what these rental buildings are basically replacing? They're basically replacing the mom and pop landlord and renting it out to the tenants. But when you change that dynamic, you're basically going to this system where the amount of product that you could actually own as an individual becomes less and less. And you're going to go into this world where you own nothing and be happy because all you're going to have is rental product. But it's not a bad thing, because if you look at the European model, the rents are very stable. They're generally like very well controlled, and you have a lot of supply for rental. But it's just, if you aspire for, call it the North American dream, Canadian dream, or US dream, to own your property, that's going to get harder and harder. And you can also see that easily with like your homeowner, which is this blue line over here. We're not building as many like freehold homes anymore. So your townhomes, your semi, and your detaches, because it's just flatlined. We're building less than what we did in the 90s right now. It's crazy. This is what I'm saying. It's very obvious there's going to be a supply crunch some way, shape, or form in the future for owners, to be specific. And then we also have to ask, where did everybody go? This is a chart that talks about Canada's inflation, and it stalled. We basically did a rocket ship, and we increased up to 3% of our population, if not more, during the pandemic years where we let in so many people, which juices up the cost of rent. But now that we're basically going down, and we may even get like to a negative like we saw in the pandemic, which means that there's going to be less demand in the rental space, which means that a lot of these rental buildings are going to have lower rents, which again, it could be good for the market, but it doesn't necessarily make it good if you're trying to own a property. And this is where the biggest lie that people have been saying in Canada is that the worst is over. It is not over. There's more pain to come. The economy is sick right now, which is trickling down into real estate market. People are hesitant to buy. Sales this year will be potentially at a 30-year low. The affordability factor, right, has not gotten any better unless you go outside of Toronto and Vancouver. And if the economy ever gets better, there is a lack of supply in the next 5-7 years in the larger cities such as Toronto and Vancouver. So the worst is not over. There's probably another leg down because the economy is very soft, but understand that there is some supply crunch in the future. When that supply crunch is relative to demand, we don't know. And this is exactly what I talk about in this video, where I try to map our current real estate crash to the US 2008 crash and our 90s crash in Ontario that we saw. And when are we actually gonna hit that bottom and recover? Make sure to watch that video to find out. I'll see you in the next video. Until next time, your move, your future. See ya.